This time last year, this is when all the trouble started. Yesterday, 1 year anniversary of the Lehman Brothers bankruptcy. We've come a long way in 1 year. We also hit new lows in March, and the markets are up quite significantly. Cobie, what sense have you made of the markets recently?
Yeah, they continue to go up. I mean, last week we had a bumper week last week. Right across the board, markets were up. The previous week, yes, they were down, and they continue to be up again this week. We had a little bit of a negative spell, early on this week, but continuously markets are continuing to be up. I suppose the big thing that people are concerned about at the moment is momentum in the market. There's a huge amount of momentum that's driving the market, and that is as the bad news continues to look better and better and better. And you can see continuous statements from central bank governors and from analysts and so on. And if you look at the data, things aren't getting worse and worse. They're kind of bottoming out, and they're starting to look better. So, at this stage, the market is kind of, if you look specifically the last 2 months, you had the market on a knife point saying, when will earnings happen? Will it happen next year? Won't it happen? Maybe it'll happen, maybe it'll happen only the next year, and then you see the market settling down on that, and then the market starts stabilizing again. But we are in a normal situation now. We're no longer in irrational behavior territory. Sentiment is now starting to become, a thing where people, not too concerned about sentiment and start worrying about fundamentals and saying, okay, what are we looking at here? There's no more, wild panic in the streets as there's going to be some form of nuclear fallout,
When you say that fundamental factors are starting to drive the market, many would disagree with that, considering that the earnings are not really reflecting what's happening on stock markets. And many say that perhaps too much has been priced in, and we are going to be disappointed going forward from here. Some even say we could see a correction of up to 15%.
Yeah, I mean, look, economic data, look at the economic data. The economic data is showing out a bottoming out effect. And I'm speaking broadly now. I mean, there's, I'm taking literally everything into consideration. So you're looking at a bottoming out effect. Yes, the earnings aren't showing it because you're in retrospect looking at the last 12 months or the last 6 months, which is not a good picture, But you got to look forward. You got to say, okay, well, if that was a picture then, how does this picture look, potentially going forward? I think the very big point here is if you look at the Aussie and you look at the 10 last biggest crashes that we've had in the Aussie, and you missed out on the first 6 months worth of returns, which, by the way, is not a foregone conclusion you're going to make money in the first 6 months, after a major crash. There's about 3 out of the 10 periods where you haven't made money. But let's assume you've missed out on that. For the next 6 months, returns are actually quite handsome still. And if you continue to look beyond that for 2 years, 1 year and 2 years, returns just continue to compound and compound and compound. And that is because the earnings picture continues to get better and better and better. And then people start pricing in the future more and more, which again has a different set of problems attached to that,
All right, historically, when was the last time you could actually make these kind of returns after such lows that we've seen?
Probably 1970s. Probably. If you look at the crash, you go back to the 1970s, you probably look at returns probably in the region of this, that you can see now. And I mean, if you look at the returns we've made now, I'm talking it's like 1 or 2% off from what you could have made in the first 6 months after this crash. So the recovery certainly has been tremendous. But that doesn't mean you're not going to make money in the next 6 months. If the recovery just continues to gain momentum, inflation stays considerably benign like it is at the moment, and you have a huge amount of cash in the system, that'll try and find a home, at some point.
But what chance is there that more bad news could perhaps stall the markets today? And considering that we also keep hearing news from Fed Chairman Bernanke that he says the recovery is probably over, but obviously unemployment is still a very big issue. On the other end, we keep hearing that growth forecasts are revised upwards constantly. I mean,
think about it like this. Can a disaster happen tomorrow? Yes. This is the world, and it's an imperfect place. A disaster can happen tomorrow. Think about the terrorist attacks in 9/11. Think about the 2001 terrorist attacks and the recession that it had to affect in the economy through to 2003. That can happen very easily tomorrow. But as far as a financial crisis is concerned, we've been through a financial crisis. So you've literally had a drying up of liquidity in the system. You've had a literally laying out of everybody's books, and you've literally had people dealing with these kind of things now. Now we can argue about have they been dealt well, has it been dealt with well, or has it been dealt with badly, and what is the net effect of this? But probably those things you're only going to see in a couple of years' time. You're not going to see those kind of factors coming to roost today.
So what do you say to those who are sitting on the sidelines holding onto their cash?
I'm saying to them that they should look at the dips in the market and look at what companies they want to own and potentially do so as part of a well-diversified portfolio of assets.
When you say well-diversified in terms of asset allocation, what kind of percentage would you be putting into equities?
Well, I mean, look, this all depends on objectives, what you're trying to achieve. You know, and part and parcel of a good investment strategy is the understanding of what objective, what are you trying to achieve? And if you can link that to your lifestyle and you can link that to where you are in your life, that obviously makes huge amounts of sense. And I mean, if you think about those kind of dynamics, then you start looking at what kind of equities do you need? Because equities are really the growth engine in the portfolio. Equities and property. I mean, the other stuff, you know, is all there for yield and it's all there for stability and so on. The reason why I say well-diversified portfolio is because well-diversified often brings down volatility in portfolios. If you can stomach the volatility and you're quite happy with the volatility, and quite frankly your lifestyle can guarantee, you know, and warrant the volatility, by all means, just buy equities, you know. But that all depends on objective, and that all depends on what kind of investor you are.